Thank you, my dear students, and today we will start our chapter number 11, Economics of Public Finance, and our curriculum for public finance. Today, our chapter will title Public Debt and Economic Performance in Egypt. So, our main topics will talk about simple intro or introduction about the public debt. Number two, reasons for the domestic public debt, components of Egyptian public debt, and the public debt in economic thought, and the relationship between public debt and economic performance. And the last point, relationship between domestic public debt and economic performance in Egypt. First, what do we mean by public debt? In general, any government, any state finance the expenditure by revenues. Finance public expenditure by public revenues. So the net situation equal total revenues minus total expenditure. Total public revenues minus total public expenditure. So when the output or the net situation is negative, why negative? Suppose the total public revenues lower than total public expenditure. In this case, there is a deficit or a shortage in public budget. But what happened if the total public revenues greater than total public expenditure? In this case, there is a surplus in the public budget. So the public debt related to shortage or deficit in public budget. When the total public revenues lower than total public expenditure. In this case, we talk about public debt. Okay? The most important problem that the public debt sustained or sustainability in public debt. In this case, we talk about accumulation of public debt. This is the most important for any decision maker when the public debt sustainable accumulated, and every year you need to pay as a country or as a state, you need to pay for public expenditure plus you need to pay for public debt. This is in general. So fiscal policy is one of the components of economic performance. In general, when we talk about fiscal policy, we talk about two tools, two economic tools: government expenditure and tax revenues. Fiscal policy, we talk about two economic tools: public expenditure or government expenditure and public or taxes. Okay, so the government try to perform some functions like number one, providing public goods, as we talk more than one time about the public goods or social goods and services. So the government need expenditure and may face public debt to provide public goods and services. Function number two, redistribution of income. Redistribution of income from rich people to poor people. In this case, we talk about redistribution of income. So the government collect taxes from rich people and convert it into transfers or subsidies to provide to the poor people. Number three, economic stability. economic stability. In this case, we talk about the level of economic performance, what about the fluctuation in any economic performance, and how the government can use fiscal policy tools, government expenditure and tax, to try to decrease the fluctuations in economic performance. So in this case, the government needs resources because there is a gap between total revenues and total expenditure for the government. Okay? So in this case, the government try to decline or reduce the public spending or and increase the public revenues. To solve the problem of shortage or deficit, the government may reduce the public spending, or and increase revenues. This is a simple intro about the public debt and fiscal policy. So, in general, the government may trade off between domestic debt and external debt. In this case, we talk about the source of debt. The source of debt. So, the domestic debt, when the government or the source of debt from domestic sources like treasury bills. In this case, we talk about domestic source of public debt. And maybe some governments try to choose or select external debt. External debt in this case talk about international debt. International debt may be from rich countries, may be from international organizations like World Bank, like IMF, and so on. But if the country try to trade off or try to compare between domestic finance or international finance, in other words, when the country try to select between domestic debt and external debt, what are the main variables that the government take into account? Number one, the impact on domestic investment. The impact on domestic investment. So in this case, when we talk about domestic investment, if the domestic debt negative impact on domestic investment time may be at the same time maybe international debt negative impact on domestic investment. But which is greater? Which is greater negative impact? Domestic debt or international debt? So the government try to select the lower negative impact. Number two, the situation or the current account. What do we mean by current account or the balance of current account? In this case, this is related to the balance of payment. Balance of payment in general, international record for the international transactions between the residents in a given country and the rest of the world for a given period of time. We'll talk about 1 year, okay? So the current account, in this case, a part of the balance of payment, which we record in the current account the international transactions related to capital and investment. So when there is a negative case or the shortage in current account, in this case may be limit to finance with the international debt. Number three, the interest rate on borrowing. The interest rate. What about the interest rate? So interest rate is a very critical variable for investment, and when the interest rate increase, it means that the cost of investment increased and may be negative for the investment. Number four, exchange rate. And what about the regime of exchange rate? Is there a fixed exchange rate or fixed regime or floating for exchange rate? Number five, the risk. Okay, in general, talk about the risk. Risk from the international debt and risk from the domestic debt. But in general, risk from international sources is greater than the risk from domestic sources. The next, what about the stability? Stability of debt. Okay, in this case, we talk about the relationship between more than one variable. And what about the impact of debt and debt burden? Debt burden in general, we talk about the debt value plus the interests. Debt burden equal debt value or debt amount plus the interests on debt. And this is the historical data about Egypt and the public debt from Said Pasha in Egypt in the year 1854, and this is related to Suez Canal and so on. Justifications of domestic public debt. Why countries prefer public debt? This PowerPoint, this slide, okay, related to why public debt, why government encourage public debt or prefer public debt. The first reason, number one, tilting in favor of the poor. Tilting in favor of the poor. What do I mean by this reason? Is in this case, we talk about that the budget or the shortage in public budget should be financed through the public debt. Why? Because we need to avoid implementing of new taxes, because maybe new taxes or increasing tax rates harm for poor people. But if the government finance the shortage by public debt, this is simple key and simple method to avoid any negative burden for the poor people. Okay. The next, tax smoothing approach. Tax smoothing approach. In this case, we talk about the stability. What about the stability of tax system? If you need at the country, if you need to create a significant change in the tax system, this is very critical for economy, and this is maybe leads to instability in the economy. So the state uses the budget surplus or deficit to avoid any sharp changes in tax system and tax rates. So we need public debt, okay? This is the scenario number one. So what about scenario number two? You will create sharp and significant change in the tax regime and tax rates. So in this case, this is the first scenario, public debt, okay, no problem. Lower negative side or negative impact on the economy. But if you need to create changes and significant changes in tax regime or tax system, this is harmful for the whole economy and increasing in the economic uncertainty. Stability. Why the government prefer any government in the world prefer the public debt? Because stability. Why? Because public debts helps to achieve stability. What do I mean by stability? Lower fluctuation in the economy. Lower lower fluctuation in the economy. So, what about other cases if there is no public debt? If there is no public debt, maybe some governments go to print money to finance budget deficit, and this is very important negative problems. This is very burden for any economy. This is disaster, economic disaster. when the economy print or when the country or when the government print money, this is very critical and the negative for any economy because in this case we talk about hyperinflation rate. So the another other scenario when we talk about why public debt, okay, we prefer public debt to avoid the country to print money, to avoid the country to increase tax, to increase tax. So this is stability in the economy. The next, financing the budget deficit through taxes take longer time compared with public debt. In this case, we talk about the time to response. Time to response. Response from what? To response to your economic problems. So when you need to, if you need to use a tax, okay, we need laws, and this law may be discussed in the organizations, and in this case we need acceptance, and this is we need actions, and this is very long time. But in case of public or the public debt, if the government try to issue any treasury bills or any tools, government tools, in this case we talk about shorter time, shorter time. And in addition, the high tax rate in any country may lead to capital flight and discourage the investment. Number E, the next. Number E, when we talk about the transfer of resources in general, in case of taxes or and public debt. In two cases, we talk about transfer of resources from private sector to government sector. So, what's the difference between? The tax is considered mandatory or compulsory transfer, no choice. As we presented in the last lecture, in case of tax, no choice. This is involuntary transfer from the private sector to the government sector. But unlike this is public debt. Public debt, we talk about voluntary transfer of resources. Voluntary transfer of resources. So in case of tax, we talk about the government intervention in the economy, but the public debt is not. The next, financing through financing through public debt is less expensive or inexpensive compared with the tax. So in this case, we talk about in democratic regimes, we talk about the voters, okay? So in any elections, the political or politicians announce about some incentives, announce about benefits for the voters to collect votes. Okay, so when the politicians use the public debt, in this case, we talk about inexpensive tools for voters to collect votes. But in case of tax, we talk about high expensive or expensive tools. So in this case, we talk about the public debt more cheap than the tax for collect or to collect the voters. The next, state may state may prefer debt financing to influence and place restrictions on the decisions of the future government. So in this case, we talk about the impact of public debt on the future decisions for the government. So the public debt, yes, we talk about burden in the budget, okay, on the budget, but we need to decrease decrease the uncertainty for decisions for future governments. Components of Egyptian public debts. Components of Egyptian public debts. Mainly, we talk about three components. Component number one, debt owed by the government, or we can call that governmental debt. Component number two, debt owned by public institutions or public authorities. Okay, any public corporates. In this case, we talk about independent economic authorities. So the debt transferred to the public debt. And the last, we talk about National Bank investment, NIB, any net debt of the National Bank investment or the National Investment Bank related to the burdens related to expenditure for the National Investment Bank. So mainly we talk about three sources: the main or original government debt, plus the debt by public economic authorities, and the net debt of the National Investment Bank. Okay, the next. What about the public debt discussion in the economic thought or economic school of thought? We will start with classical thought. Okay, classical thought, to remind you, when we talk about the father of economics, Adam Smith, and David Ricardo, and John Baptist Say, and Maltz, and so on. So this is the first generation of classical thought. What about the main ideas for classical thought? Number one, economic freedom. Economic freedom equal the main rule in the economy achieved by private sector. The main rule in the economy achieved by private sector. And no intervention by the state in the economic activity. We talk about limited rule, very limited rule in the state, by the state in the economy. Neutral of fiscal policy. What do you mean by the word neutral? Neutral of fiscal policy equal our budget in balance. Our budget in balance. So total public revenues must equal total public expenditure. This is the neutral. Total public revenues equal to total public expenditure. No surplus, no shortage. This is the word neutral. Neutral of fiscal policy. The next, full employment. Full employment equal all available economic resources employed. Again, all the full employment equal all available economic resources employed. And the last, traditional functions of the state. Any state, according to classical view, should do the following. Number one, national defense. Number two, security. Number three, infrastructure and justice. So, only four functions. Only four functions. Okay? For the state. So, in general, as we explained that there is a neutral of fiscal policy, this means that no shortage, no surplus, and in this case, there is no need for the public debt. According to classical view or classical thought, no need for public debt and discourage public debt because our budget imbalance. No surplus, no shortage. So classical thought dislike any public debt because if there is a public budget imbalance, okay, this leads to state intervention, and this is a restriction for the private sector. Okay, so the classical thought dislike and discourage any public debt because the public debt, okay, leads to intervention from the government. And the main idea for classical, no intervention by the state or by the government in any economic activity. Only four functions: national defense, security, infrastructure, and justice. So we will present some points of view for the classical leaders. Number one, Adam Smith. Adam Smith introduced or talk about the crowding out. What do you mean by crowding out effect? The crowding out equal that the public debt leads to negative impact on private investment. This is the concept of crowding out. And this is lead to negative impact on the economy. What about the point view or the view number two? When we talk about John Patsey in this case talk about this is a classical economist that domestic public debt helps to growth of irrational consumption. So we fight as a classical, we fight this public debt, okay, to encourage rational consumption. What about David Ricardo? David Ricardo talk about the problem of tax evasion. Tax evasion, in this case, we talk about you try to avoid or try to pay lower amount of tax, okay, because the tax increase and you will go to do the tax evasion. Number four, public debt with a high interest rates, and the high interest rate in general, all in all, we talk about negative impact on economic activity and maybe leads to problems in banking system. Number five, public debt like private consumption leads to wasteful of the state wealth. Wasteful of the state wealth. So, all in all, we talk about the classical thought discourage the public debt. The other school, when we talk about Keynesian thought, Keynesian, Keynesian thoughts, we talk about the ideas introduced by John Maynard Keynes. Okay, so the Keynesian thought, unlike classical thought, Keynesian thought rejected the ideas for classical thought about the budget balance, okay, and maybe according to Keynesian thought, there is a valuable shortage in public budget. Then we need a public debt, okay? We need a public debt to encourage the economic cycle, but this debt should be temporary and in short run, okay? Not be sustainable. So in this case, there is a difference between classical view in public debt and Keynesian view of public debt. Classical discourage and dislike the public debt, but Keynesian maybe encourage the deficit in public budget, and we will go to the public debt and use the public debt to solve this problem, but should be temporary key. What about new classical thought? In new classical thought, we talk about ideas by monetarists and the supply side school. New classical, we talk about monetarists and the supply side school. So, for monetarists, from the name, we talk about the importance of money supply. The importance of money supply. So, it's necessary to control money supply, okay? So, the public spending and the public debt is very harmful for money supply. So, there is a problem with the government to eliminate the deficit in public debt. So according to monetarists, the monetarists discourage the public debt because its negative impact on the money supply variable and leads to inflation and so on. For supply side school, in this case, we talk about how you can stimulate the supply side in society and increasing the production by decreasing the tax rate. Supply side school encourage to decrease or reduce the tax rates. Okay, but maybe there is a criticism for this view, and because the negative impact in the economy, and in this case we talk about another view like Arthur Laffer introduced a very important curve we will present in the next slide. Arthur Laffer, that there is a relationship between tax rate and the revenues, and there is optimal tax rate. The last school, when we talk about rational expectation hypothesis, this is the last school. In this case, we talk about the rational expectation discourage any intervention for the government in the economic activity and avoid the public debt. Okay, this curve not including in the textbook. Pay attention, please. This curve not including in the textbook, and we will explain to discover the optimal tax rate. Okay, in this case, we talk about the relationship between tax rate and tax revenue. Tax rate and tax revenue. Okay, so for the first time, when tax rate increase, tax revenues increase. So in the first stage, we talk about positive relationship. Higher tax rates increase to tax revenues in the first stage or before the optimal. When go to the optimal tax rate, in our example, for example, this is for example 60%. We suppose that this is 60%, this is the critical tax rate or the optimal tax rate. This tax rate leads to the maximum tax revenue. Maximum tax revenue. Suppose any increase greater than 60% leads to lower tax revenue. Lower tax revenue. So in this case, there is no incentive to work. This is the idea of Laffer curve. So I'll talk about two relationships before the optimal tax rate. We talk about positive relationship between high tax rate and between the tax rate and tax revenue. Before this is before the optimal tax rate. After the optimal tax rate, we talk about negative relationship between the increasing tax rate and or the tax rate and the tax revenue. The next relationship between public debt and economic performance in the economic literature. Well, first we will produce or talk about the Keynesian analysis in general as we presented in the last slides. Keynesian maybe talk about there is available shortage in the public debt and maybe need the public shortage in public. This is we don't talk about public budget, but we need the public debt, but must be temporary in short run. According to Keynesian, public debt may have a negative effect on economic performance, but when we talk about the positive impact of public debt, in this case, we talk about increased the government spending. Okay, the increasing in government spending leads to public debt. But all in all, the public debt may lead to negative effects on economic performance. What about the level of debt? The level of debt, in this case, we talk about in the level of debt, this is maybe positive impact in economic performance, but This is with reasonable or lower level of debt. We will classify the level of debts into two categories. Category number one, reasonable or lower levels of debt. In this case, there is a positive impact on economic performance. But with high levels of the public debt, the relationship converted to negative impact. Number three, classical view. In this case, we talk about the Ricardo's view, and the public debt is neutral, okay, and its impact on economic performance because the classical thought took about neutral fiscal policy. Relationship between domestic public debt and economic performance in Egypt. We talk about the relationship for the time or the period from 1986 to the year 2009. So, number one, what do we mean by the results? Number one, domestic public debt in this period had a positive impact in economic performance. This is for Egypt. Okay, this is a study for Egypt. And number two, the economic performance didn't affect the domestic public debt. So this is maybe the result number two in Egypt. And the large part of domestic public debt in Egypt goes to pay its burden. This is very critical result. The public debt in Egypt, okay, employed to pay the burden of lost debt. So in this case, talk about accumulation of public debt in Egypt, and this is the very important part. Significance of the public debt related to the consumption or the government consumption for luxuries goods. Okay. Number three, public debt represents a transfer of large part of the saving of the private sector to the government, and the last, positive impact of domestic public debt on the economic performance in Egypt. And in this case, this is the summary for the study related to the relationship between public debt and performance in Egypt. Thank you, my dear students, and see you in the last lecture.